Here's some view from Morgan Stanley. Basically, semiconductor and the mega AI companies are getting very crowded with investors now. Everyone's there, everyone wants a share of the good things that are happening there. At a certain point of time, some investors might rotate elsewhere. The good thing in the US is equity rally can broaden beyond semiconductors and AI, and here are the four. Firstly, consumer discretionary goods. There's been a shift in consumer spending from services back to goods, improving pricing and stronger earnings revisions. Next, transports, the industry. Benefiting from improving earnings expectations and broader economic recovery. These are the ones that are having good earnings, but because AI and semiconductor are too loud, they got pushed into the shadow. Third, banks will very likely be supported by better loan growth because of the steeper yield curve. Let's look at the right first. The steep yield curve is the line in green. A normal yield curve will be the one in blue. Steep yield curve happens when the longer-term bonds' yields rise faster than the shorter ones because investors demand higher yield on longer-term bonds to compensate them for the risk of inflation over time. So why do banks benefit? Because of the way they operate. Banks usually borrow money at short-term rates, hence paying lower interest fee, and lend it out for long-term, like mortgage or business expansion loans, those that go long-term. From that, they get to charge higher and earn more interest income. When the gap between the short and the long term widens, this is when banks will earn even more from loans. Lastly, biotech. If the expectations of interest rates in the US turns out to be lower than what everyone thinks, biotech industry will pick up, especially the M&A activities. Markets may be too hawkish now. If the weaker labor data, lower energy prices, and leveled core inflation allow the Fed to avoid further hikes, lower rate expectations could support these broader sectors. The bottom line is, it's not that it's time to look outside of AI and semiconductor. These are still benefiting, but it's getting very overcrowded, and expectations are too high. At any point in time, when there's disappointment, valuations of those industries will fluctuate, and investors might rotate outside of AI and semiconductor just to have a more balanced portfolio. Europe has a consumer problem. Since the war in Iran, high inflation levels, especially coming from the high energy prices, affect Europeans a lot. European households continue to save even more money than spending. They save a much larger share of income than before COVID. This is a limiting and important driver for Eurozone's economic growth. Household spending in EU accounts for almost 52% of last year's nominal GDP. That's a lot. If consumers are not spending much, it'll affect Eurozone's economic growth. Look at the chart on the right. The one in orange is Eurozone, and the one in light blue is the US. Eurozone household savings continue to be high above pre-pandemic levels. But there's some hope. Since 2024, there's an increasing amount of money from European households going into investment funds, as well as insurance, pensions, and long-term investments. This amount is far smaller than the one in the US, but it's picking up. You can see the breakdown in the chart at the right. Investment funds are gaining ground in financial portfolios of European households. So eventually, if Europeans continue to allocate more of their savings into investment products, and then when they see that their wealth start to grow and then dividends start to compound, this will give them some comfort over the high inflation levels. Eventually, they'll feel less pressured to save and start to spend more. The key point is, if that happens, domestic demand could then get a lasting boost. On to China prices. Consumer prices grew slower than expected. A couple of months back, CPI became high because of high energy prices. But when energy prices start to drop, China's consumer prices drop. It's clear that the domestic demand is still very weak. Both headline and core consumer prices grew at 1% year-on-year. With the lower oil prices and the with headline and core consumer prices being the same, you can see that services prices aren't high, again because of the weak domestic demand. With such poor consumer demand, factories and businesses can't really pass on the new costs to their customers, which is why producer prices jumped 4.1% year-on-year. Look at the trend in the chart on the right. The huge pickup. Besides higher commodity costs owed to war-led supply disruptions, wholesale prices have also been lifted by a growing demand for artificial intelligence computing power, pushing up prices for tech equipment and semiconductors. But the good thing is, China has been benefiting from the high external demand for AI-related tech, and it's still driving the momentum. The problem is that investors have concerns with the contrast. Strong exports momentum versus the weak domestic consumption and the prolonged housing downturn. Next, the International Monetary Fund raised the growth forecast for China by 0.2%, landing at 4.6%. Then, they trimmed global economic expansion to 3%. That shows their confidence in China's growth for this year because of the robust high-tech manufacturing and export performance. On to South Korea's equity index. The index recently entered bear market territory after falling about 20% from the peak on June 19th, but it's still up more than 70% for the year. You can see the trend at the chart on the right. The main issue is the extreme dependence on AI and semiconductor trade. This index is heavily driven by Samsung and SK Hynix. The two made up more than half of Kospi's weighting. So investors started questioning about AI spending and future earnings growth. The entire index was hit hard. The key point is the sell-off is very likely profit-taking than low sentiment. Investors are questioning the pace of growth. The market is not necessarily saying that AI demand is disappearing. Instead, investors are asking whether the AI capex will continue to grow very quickly. Will semiconductor earnings continue to bring positive surprise, or it's been too optimistic? And will memory chip profits keep accelerating at the same pace? So, the near-term outlook for South Korea equities is it remains highly volatile, but fundamentals still appear strong. Look at the 5-year index performance. Zooming into this year, it's been mostly green than red. Here are the few things. Memory prices increased 50% to 80% and is still supported by the multi-year supply shortage. The high demand is still there, and hyperscale customers enter into long-term contracts with semiconductor suppliers. Samsung and SK Hynix are still the central positions in global AI supply chain. Let's compare it against S&P. Look at the breakdown. The left is Kospi 200, the right is S&P 500. Firstly, TMT comes in at 11.5% of Kospi. That means 23 entities out of the entire 200. But look at the top two. Industrials and consumers weigh a quarter each with 50 and 49 entities, respectively. Now look at S&P. TMT is about 1/5, and whatever below TMT are between 10% to 15%. It's more well-rounded. The issue is investors may buy the Kospi for AI and memory chip semiconductor exposure, but then the top two constituents are industrials and consumers. So even if semiconductor stocks rise, but if industrial and consumer companies disappoint, the overall gains will be diluted downwards. Second note to think about is Korean equities are highly influenced by global institutional investors, and they're often viewed as the second to US and China in terms of allocation. So when risk appetite weakens, there's a lot of foreign selling. And then for cyclical sensitivity, South Korea is highly exposed to exports. When energy prices continue to be high, this will affect them. The top 3 industries in the index are related to exports. So overall, Kospi 200 is less suitable for pure AI and semiconductor investments. Let's link the topics to the market. This isn't a buying guide. It only shows how global trends affect different industries. Firstly, we just covered SK Hynix. The shares went up more than 340% in this year, driven by the strong demand, memory shortages, strong pricing, hyperscale demand, long-term contracts. Second, Kinetics Pharmaceutical. We covered at the first section that outside of semiconductor and AI, biotech may perform well when the market thinks Fed may not need to stay as hawkish as what everyone feared. Vertex agreed to buy Kinetics at a 102% premium. Third, Montage Technology is also in semiconductor. The shares jumped 64%. Investors want the exposure in data center memory interface chips. We went through that China's manufacturing has been supported by AI demand. Lastly, we went through that Europeans are slowly reallocating their cash, excess savings towards funds, and long-term investment vehicles. And just so happens, Schroders shares jumped about 28% after Nuveen agreed to buy the company.